Last week, there were two different energy sectors on display. The week began with OPEC Plus announcing increased supply. Crude prices fell. Energy executives expected a better business climate than this when Trump won the election. Although there wasn't much enthusiasm for drill baby drill, most thought that the new administration would help them boost profits with a lighter touch on regulation. Instead, they've had to endure lower oil prices as the global economy braces for slower growth caused by the import taxes. The White House has even welcomed falling crude as helping curb inflation, which would otherwise be higher because of the tariffs. Diamondback Energy, a big shale producer, trimmed their spending plans because of lower prices. Others will follow. Occidental Petroleum, where Berkshire owns 28%, has lost almost a quarter of its value this year. U.S. oil production now looks like it won't grow much, if at all, this year. Later in the week, oil recovered on hopes for some trade deals. Crude was the biggest story of the week. I was even invited on Schwab TV to talk about the outlook.
Simon Lack, founder, managing partner, SL Advisors, and portfolio manager of the Catalyst Energy Infrastructure Fund, is joining me right now here today. So, Simon, what are some of your thoughts on what's going on with oil right now?
Yeah, I think it's really a supply problem. Demand's growing. I think demand's probably going to be up 750,000 barrels a day or so this year. But supply has been going up. A lot of that supply increase has actually been non-OPEC. There's certainly been some cheating within OPEC, but supply is going up elsewhere as well. And then you've got some of the OPEC nations that are adding capacity. You're going to see the UAE probably adding about 400,000 barrels a day of capacity over the next 2 years. Iraq, probably another 300,000. So I just think that even though, there are people who are saying that oil demand is going to flatten out and maybe even we see peak oil, the sellers of oil, suppliers, don't expect that. They're acting accordingly. And I think that that's really what the challenge is.
While all this was going on and causing sharp moves in E&P names, midstream was quietly getting on with business, not too affected by tariffs or swings in the price of oil. Williams companies raised full-year guidance. Cheniere had another great quarter. They've picked up the pace of their stock buybacks. U.S. exports of liquefied natural gas are averaging 15 billion cubic feet per day so far this year, up from 12.5 last year. Cheniere is our biggest exporter and will be adding capacity for years, bringing cheap, clean-burning natural gas to our friends and trading partners around the world. There wasn't much drama in midstream. There rarely is. When investors consider allocating to energy, one of the first things they think about is the outlook for oil. Pipeline companies are all about volumes, not commodity prices. They just keep processing, moving, and storing hydrocarbons for their customers. Commodity prices move around, volumes not so much. And there are important drivers of growth with LNG exports as well as demand for power from data centers. Energy Transfer said on their recent earnings call they have up to 150 data center proposals just in Texas that they're considering. More gas exports and more gas for electricity are two themes that aren't affected by the price of oil. What it means is that there's a nice, quiet sector of the energy market that is generating steady cash flows, supporting 5% dividend yields, buying back stock, and taking advantage of growth opportunities. It's natural gas infrastructure. We think that if you want to invest in companies that have good earnings visibility, low leverage, and limited exposure to tariffs or commodity prices, midstream is the place to be. Energy is President Trump's favorite sector. There's a part of it that's pretty free of drama too. If you're interested in learning more about the energy sector and interest rates, then don't forget to subscribe and follow us on LinkedIn and Twitter. Our handles are in the description box below. To find out more about what we're thinking, you can sign up for our twice-weekly blog at sl-advisors.com. If you have any questions you'd like answered in this video, then please leave them down below. I'm Simon Lack. Thank you for watching this video.